everybody. Welcome to Friday, another Talk Money with Tom show. We are coming live from Silicon Valley today. We do this every Friday, 12:15 to 1 o'clock. And what we try to do is just answer questions. We usually start off with a summary of what we're going to see, happened in the market for the past week. And then you can send in your questions, send them in now. You can send them in during the week. You can do it a couple different ways. You can email us the questions at asktom@talkmoneywithtom.com, or you can just put them in the chat here during the show. We'll try to answer those as they come up. We believe that the more you know about retirement planning, asset management, and tax planning, the better your retirement will be. And this is irregardless of age. So if you're looking forward to your retirement, you're already deep into your retirement, a lot of the things we talk about will apply to both groups. And of course, retirement is more than just money, and we focus really on the money side, which we feel is important. It does seem to help to have things set up and not have so much fear about, what might happen. And so we created this channel, talkmoneywithtom.com, and we have created lots of content on here. So you can go ahead and subscribe to the channel. It actually helps us too if you subscribe, which is great. You can hit the little bell button, get notified when we put new content on there. And then, of course, we are available for appointment. If you'd like to meet with Ethan and I, talk about your specific situation, we provided a live schedule online on our website. You go to the website, the link is here on the channel. You go up in the corner and there's a book appointment button up there, and we're really, available to meet with you for like 30 minutes, let's say, on a phone, a video. You can come into the office, whatever works for you as far as that goes. So look forward to being able to hopefully help you today. Please start sending in your questions. We love to answer these things as they go. See if you can find some things that you find interesting. We can guide the show in that direction. Appreciate that. We do always like to start off the show with a summary of kind of what we saw happening in the stock market this week. Really spectacular week.
Yeah, it's actually a great run so far.
It really is. It's incredible. And I'm going to go through my checklist again because I've been getting a lot of questions about that. Talked about this last week, update a couple pieces of that and show you. But in essence, seems like everybody else had a similar checklist because once everything was checked off, this market is really gone. It's very significant what's happening right now in terms of this market motion. We've actually been talking about this really all year. Since the middle of January when we kind of finally hit a new high, we've been talking about the market kind of doing the right things, the things that we like to see. And so we've seen this big run up here. And I think one of the things that's very significant this week that is very pleasing to me, if you recall last week we were talking about the run that the market was having was kind of narrow. And we even had a really great visual showing kind of the top 7 stocks on the S&P 500 versus the other 493.
Yeah.
And I just saw a headline today saying the S&P 493, they're calling it now, is now participating in this run. I'm not surprised. We talked about the fact that we felt the narrowness was because of the debt ceiling. Usually when you have narrowness, it's a sign that things might be petering out. Right? And you need that breadth to kind of get yourself convinced that this is for real, that things are going to move. And I think because the debt ceiling, money was being funneled into the 7 companies they're talking about have huge cash positions, lots of cash flow, great name recognition, those types of things, the Microsofts, the Apples, the Googles, etc. And so, as the market has adjusted to the debt ceiling, being resolved, so to speak, until January of 2025. We started to see some more breadth come into the market, and really big inflows are happening into funds right now. And you can see it. It's coming through in the charts and such also. So very, very nice market. And of course, we've had a green signal going for our stock market indicator since early May. And so we're still green on the fast and green on the slow. And so, again, just to reiterate, these are signals that we have developed. They have a multitude of different things that come into play to kind of figure out, what is happening. But the main key thing that we look at is the movement in the stock market price. I'm a big believer that a lot of the things are already baked into the price, a lot of knowledge that you and I don't have. So, a great example is the debt ceiling. So I probably had the most calls and emails about this particular event that I've had in the last 12 months was about this debt ceiling as it got closer to the edge and what have you. Yet if you watch the market, it didn't fall. Mm-hmm. It didn't even have a 5% fall from one high point to another. It sat there. It didn't move a lot. There was volatility. There was reason to be concerned, but the market was, okay with what was happening. And we see that a lot, and you really want to kind of pay attention to that because, theoretically, there's an awful lot of participants in the market. There's a lot of money. There's a lot of intelligence that's going in there, and when it's moving. And so that plays now, too. Because when you look at the headlines now, what are they saying? Right? They're saying, hey, we still have this big recession coming. Yeah. The Federal Reserve is, going to over-raise rates. And we'll talk about what the Federal Reserve did this week and some of the things they said. But when you look at that market, it's not believing that particular story.
Yeah, they're projecting it further out, and they're not worried about the recession, possibility of recession.
Yeah, and all of the second half of last year was about this big recession we were going to have in the first half of this year. And we start off the year going up right away. Came down and came back up, but nothing really, signaling to me from the stock market motion that things were really going to be falling apart. Now, that can change, right? Things can happen, but let's just take a look at the checklist again real quickly that happened, because I think this is important to kind of understand. And so the theory is there's a primary direction, and you really want to be invested in that primary direction. So if the primary direction is down, you can see that blue line there connecting those tops. And that's how you look at direction. For down, you connect the tops, and for up, you connect the bottoms, right? Mm-hmm. And so obviously we had a primary direction down in 2022, no doubt. They raised rates a lot. Inflation was very high. We hit 9% on the CPI, all those things. And then what you're looking for is when that changes, and so that you can feel more comfortable with getting into the market. And, you probably should always be in the market with some portion. We're a big advocate of that. But, how much you have in, what type of risk you're taking can change depending on market situations. And so the signals on our bond market are a little bit different. We have a green still on the fast and a yellow on the slow. And so this is somewhat important because we are seeing some softness in the bond market. Mm-hmm. And so the bond market is reacting a bit more like the articles would like them to do, in sense of, hey, there is some potential for higher interest rates, which could create some problems. And that's usually the one main thing that bothers the bond market is when rates are going up, the values go down, right? Still green and yellow, but we're still seeing some softness even in that green. The fast signal is very close. So, we're still watching that as far as that goes. And we'll talk about that differential here in a moment. But first thing on a checklist for me was just kind of breaking that trend line. So I trained it to red here just because it was a down motion. But we broke through it twice, once really, and then held, which was nice. And again, I went through these already, so I'll do them fairly quickly. The 200-day moving average is another really big one. I had 3 moves through that didn't hold, and then finally, we broke through and held. The golden cross, another really big one within the investment community. If you talk about the golden cross, it's called the death cross the other way when it comes down. And this is the 50-day moving average, moving up through the 200-day moving average, right there where that arrow is. And so again, we had that. That's spectacular. And one of the big ones for me is setting new higher highs, right? So you can see in those red circles, we were setting lower highs with big runs, huge runs, but lower. And then this 2 green circles here, that's this January and the run that we're in right now. And of course, a little hard to see this, but a 20% up market is a bull market by definition. We hit that last week, right? We talked about last week that the average run approximately for a bull market is 5 years long, on the average rate of returns about 177%.
Yeah, and even the worst bull market was still a 2-year run and a 50% up market.
So let's think about that for just a second, because that means a lot. So that means that basically everybody that's writing an article saying that the market's going to fall sometime in the rest of this year, 20%, 30%, or whatever it is, what they're talking about is something happening that's never happened, in the data set that we're looking at here. Yeah. Now, unfortunately, the data set that we're looking at doesn't probably have a pandemic. So it does make this a very strange environment. But actually, what's happened so far is that the pandemic has been on the positive side here in this year because people are spending money, getting out, and doing things. And there's still people that aren't doing as much as they were doing before the pandemic started, and that's still ramping up. And I look at that as kind of like reserve pent-up demand still coming online. And we just got retail sales today, and it was very good,
Yep.
and that continues to go. It continues to happen. Even some signs of life in the factory arena today in the reports that came out. So again, think about that for a minute. If the market is going to come back down and it turn into a bear market, which would basically be falling 20% or more from here, and it happened before 2 years were up, it'd be the first time. First time for everything, but the probability becomes somewhat low,
Yeah.
right? So that's important to remember how this goes. And so this is the one I wanted to update because we had not broken through, as of last week, the high from last summer. And so you can see, if you look real closely here, and actually maybe switch to a different view so you can see this a little better. You can see it how it bounced around right below, just before. And then once it broke through, it took off. That's a little bit different than what we've been seeing on this whole chart. A lot of these breakthroughs have turned into fall back down right away. This type of breakthrough is what you saw in 2021 and 2020 when things are really going. And it's actually, I think, more of a normal breakthrough. Market kind of is trying to get through, and it gets through, and then whoosh, kind of fear of missing out, people covering shorts, whatever it is, there's things happening as far as that goes. So, we're fully invested in this motion here. We've got some, we've got our semiconductor index, we've got our cybersecurity index, we've got our ESG pieces, we have our cloud computing, which has gone bananas, right? And a lot of pieces that have some exposure to artificial intelligence that have done well. And so, we're participating in this. We're ready if there's a downturn. And I mentioned yesterday in my daily video that be a little cautious because today is the options expiration day, right? That's a very volatile day. And a lot of things that actually did quite well will do poorly on a day like today. So don't be surprised at all to see some downturn in the technology in the leadership area that we've seen here, which is what I saw before the show started as far as that goes. And so that's happening. And then, of course, here we are at the 16th of June. The 30th of June is the end of the quarter, just 2 weeks away. And the huge thing that happens at the end of the quarter is that these big funds rebalance.
Yep.
Right? And so you've got, let's say, a target date fund, target date 2027, 32, whatever it is, doesn't matter. They have certain targets for how much they want to have in U.S., how much in international stocks, how much in stock versus bond. And then they rebalance those back to their target ranges. And so the stock market has done a lot better than the bond market.
Yeah.
So we would expect over the next couple of weeks that these target funds, and these are big funds, they're huge because it's 401k money that's coming in constantly. We would expect some selling of stock and some buying of bond as far as that goes. Again, some more potential volatility combined with that huge stretch. That's a pretty straight up market motion that's happening right now.
Yeah, in the relative strength index, you can see it's way over.
Yeah, it's stretched out quite a bit here. And, I've always talked about the rubber band, right? So you kind of have a rubber band and you stretch it and you get a little bit of resistance, but the farther you pull, the more resistance you get until things kind of come back down. It can go the other way. You can get too much fall, the market just falls really quickly, and then you get that kind of bounce that happens. And you can see some examples of that. Now, it's difficult to tell. You can get a fair amount of stretch either way, right? So it's not, there's no formula for it. It's just, I'm looking at this. I'm looking at what's coming up for the next couple of weeks with options expiration and rebalancing. And I wouldn't be surprised to see us come back down and even challenge that purple line there, just because that's kind of the norm. And it would be, I think, healthy because a market that just goes up unabated can often come down unabated. So it's, build a base, stay up there, keep on moving, and, see how things play out. So that's really, really critical to understand. But like I said yesterday, the options expiration and rebalancing, those aren't fundamental issues. That's not lower earnings or lower retail sales or higher unemployment or whatever basic metric that you really want to look at. It is just a mechanism that happens inside the market that creates these issues. I think it's important to understand so that you're not thinking, hey, the market's telling me that things are falling apart. Make sure you've got your glasses on that say, okay, this is a weird time frame. We need to kind of let this play out, because we have seen that at the end of September, right? We had a huge drop. The end of last year, we had a drop. The beginning of this first quarter, not as much happened. So we'll see what happens this time. But just something to be aware of. All right. So there are other things that are on my checklist. One of which was to resolve this debt ceiling. Yes? Okay, we did that. Awesome. The other is to have lower inflation. Mm-hmm. So CPI was reported today. And so this is the CPI, which is the Consumer Price Index. This is a basket of goods, right, that is put together to measure how much inflation happened, in this case, year over year. So we're looking at last month, right? So for May, how much did inflation grow over the May of 2022, right? So they're saying for the basket of goods, the whole basket, it went up 4%. Well, it hit 9 back in July of last year. So that's fantastic. Matter of fact, that chart looks awesome.
Yeah.
That's exactly what we want to see. We want to see that continuing to come down. The more that comes down, the more you're going to see that stock market go up. So this is a big piece of the checklist. However, we do have to be a little cautious, because this is what they call top-line inflation, which includes food and energy. And so food and energy is actually coming down in inflation, what they would call disinflation, right? There's deflation when things get cheaper. That doesn't happen quite as often. Disinflation, which is a new word to me, but that was used by Chairman Powell a few months ago, which is, inflation growing slower, right? And that's definitely what's been happening here. And then inflation is just, increasing prices. So if we look at core inflation, which is this chart, this is taking out food and energy. Now it's at 5.33%, so it's actually higher than top line inflation.
Yeah.
And it's a lot stickier. Yeah, you see that? I mean, it's just kind of hanging in there. And so one of the main things with this particular index especially has to do with rents. So describe how they calculate it, because it's kind of interesting, and how they survey it.
Yeah, and so they essentially survey, they have 50,000 samples that they try and get, and then they survey that person, they stagger it. So every 6 months they'll come back, and so there's that kind of lag period between each time they survey the same person again and again.
So they're talking to somebody every month, but not the same people, so they have a groupings that they're talking to every 6 months.
Yeah, and they try to get you different areas, try and figure out. And they also don't use housing prices. They use what they consider owner equivalent rent. And so it sometimes it's not as equivalent to housing prices, and so there's some sort of disconnect.
It's probably the biggest piece. Well, not probably. It is the biggest piece that's making this be sticky, according to Jay Powell, because the Federal Reserve came out this week and had their meeting and said that we're not raising rates. So first pause in 15 months, which is awesome.
Yep.
Market has enjoyed that. And he talked about what they call shelter, which is, rents in this particular case, and how that can be kind of sticky, and how it can also be sort of a lagging indicator. Mm-hmm. And it's one of the reasons that the Federal Reserve doesn't use this consumer price index as heavily as they do the personal consumption expenditure index, just because there is a different way and a bit more shelter in these. Now, rents are expensive, right? And they, are a big issue, and they're a huge expense for people. They should be counted. How you count them is difficult. And you were telling me that Zillow has a measurement of rents based on the rents that are being asked for right now versus the rent that were being asked for last year in May.
Yeah, and they're only in the 2% range, so it's a stark difference.
Yeah, so that's the differential in lag. So what's being asked for in rent is somewhat reasonable on increase in that kind of 2-3% range, and what we're seeing in rent increases in the past was higher. And so when they're doing these surveys, there's this lag. There's some hope and expectation that this core inflation will fall throughout the rest of this year, because we're starting to see that lag in rents catch up to the reality of, rents normalizing a bit more, in this environment. So that's our summary for this week. Really great time frame. This is fun. I really enjoy this. And so hopefully you've been able to follow along, kind of showing you what we're working on and what have you. And right now, again, green light. The bond market is something that's a little softer. We'll have to see what happens, but look forward to being able to talk to you again. We will not be having the show next week, right? But we, every week we try to cover this summaries and what have you. So we'll try to fill that in too. So look forward to seeing you next time. All right. So let's talk about, the questions that came in. So what do we have to work on?
So, with the Fed expecting 2 more rate hikes for the year, what can we expect from the bond and stock market?
Okay, so this is important to understand. The Federal Reserve has come out with what they call their Statement of Economic Projection. They do that 4 times a year. They meet 10 times. So they were not going to meet in August, for example. They actually do meet, but it's not an official meeting. They have a get-together in Jackson Hole, Wyoming, right? But so they missed a couple of months. But those statements of economic projection, they put in there what they call the dot plot. And the dot plot is kind of a consensus amongst all the Fed governors for where they see interest rates going. And they were seeing in this last one that just came out this week, 2 more rate increases for this year, 1/4 point each. And so they did pause here. Now the market is currently, as we sit right now, expecting 1 more rate increase. That's a little bit different. Actually, the last show, we showed you what the market was expecting, and it was expecting 1 increase and then 1 decrease before the end of the year. Right now, it's just 1 increase. So the differential is pretty small. The Fed says, hey, 2.5 point altogether. The market is expecting 1/4 point increase for the year.
Yeah.
Personally, when I look at that, I don't think there's going to be enough of a differential there to really have a huge impact. Again, on the point in time that it happens. So let's say that there's a Fed meeting in September. They've raised rates in July, which is now up to 70 some odd percent expectation that they will raise rates in July by a 1/4 point.
Yeah.
So let's say that happens. The market has been quite accurate as to where the Fed's going. So then the next rate increase, the first one they could do after that would be September. Let's say they do another one in September. The market's still expecting nothing. Then the market's going to have trouble during that period of time. But if you look historically at interest rate increases, the market does struggle like it did last year during those high increase periods of time, and really churns and has lots of volatility, which is roller coaster aspect of what we had last year. So this particular scenario, though, between 1/2 point and a 1/4 point, I don't think it's going to matter that much. Probably has more impact on the bond market, right? Just because the bond market is much more sensitive. But even then, I think the bond market's kind of already somewhat normalizing to the situation.
Yeah, as you go higher in interest rate too, every time you do an increase, it's kind of like a smaller percentage of an increase. So it's not as impactful once you get to those higher input. So like if you're at 1%, you increase a 1/4, that's a big increase versus at 5% increasing to 5.25.
That's a great point. I mean, it's almost negligible, really. I mean, right? I mean, we were at 0. And then we got to 1/2 point, and so we doubled when we went to 1%, and so those were big differences. And so going from 5, to 5 1/4, it's just about negligible. So, and we are seeing a decrease in inflation across the board. Core inflation still needs some work. It's got to come down faster. It'd be great. There probably will be some, and this is just my thought this morning when I was thinking about this. I think we're going to see a jump back up in inflation at some point in time. That happened in the 70s. It's likely to happen here. And one of the reasons is, my thought here is that, the stock market is really going nuts. And when the stock market goes up that much, it creates this kind of loosening of financial conditions. It's not tightening. Now, there's tightening going on when they raise rates. There's tightening going on when the regional banks are no longer lending as much money because of their issues. So there's tightening that's happening. But if people are starting to spend more because they own Nvidia stock or something, that's gone bananas, then exactly. Well, you just feel more confident. It's even if you don't have the money, sometimes you might spend it if you feel more confident than when you feel really worried about the future. So, I think there'll probably be some issues that we're going to have to deal with here. It's why inflation is such a big deal. It's really hard to wind it out of the system.
Yeah, it
It
takes
takes a
time. It's
while.
not a fast
Yeah.
process.
No. Um, so it took years to kind of build it up. It'll take years to get rid of it. All right. Next question.
Will there be any repercussions for the debt ceiling argument and kind of like the whole like issue with that? And what happens to bonds with them now to issue so many treasuries?
Yeah, I think overall repercussions for the debt ceiling are negligible at this point because it's now two things happen. Number one, they did it, they extended it, but they did it in an interesting way. They extended it to a date, so it gives the Treasury the ability to go and issue new debt without having to worry about a number. Like we were at 31 trillion, I think was the number for the last debt ceiling. That makes more sense to me because it's very difficult to tell what the number should be, and sometimes the number comes in right in the middle of the year when they aren't really working on the budget and that kind of thing. So at least now it's pushed off. However, there was a big period of time here because we reached the end of our normal debt ceiling in February and didn't extend it until June, and they were using extraordinary measures and borrowing from different areas and federal pension money. They're going to want to replenish that. So I think probably what we're seeing in terms of the overall market's softness for the bond market has somewhat to do with the fact that the Fed is probably not the Fed, the Treasury is probably issuing a lot of bonds. So I would expect to see some continued softness there for a while. And that's been an issue. The bond market's been struggling for quite a while here, since the beginning of last year.
Yeah.
But it has had a decent run to come back. I think we'll see some softness there. So we have a yellow light on our slow signal, and so we have a defensive motion in our longer term holdings, taxable accounts, those types of things. And so I think that's temporary. I think it works its way out. I think once the Federal Reserve really does get through these rate increases, the bond market probably does do a lot better, at least stabilize. So we'll see how that plays out.
I have an international index fund in my 401k allocation, but it always seems to underperform like other kind of pieces. Should I be keeping it?
Okay, so there's a couple things here. There are some segments of the international market that are doing better than our market, right?
Yeah.
Mexico and some of these places, if you look at, and you can buy any slice of the international arena. It's crazy. Every ETF, exchange traded fund out there, you can imagine, you can buy any country. So, but in a 401k, you're not going to have access to that. In a 401k, you're going to have access to probably some broad-based international, maybe emerging markets.
You might have developed versus emerging.
Yeah, you could have developed markets, which would be the big ones, and emerging markets, and then sometimes you might have the total international type thing, which would include both. If you look at those, even this year, they were hanging in there this year, but not now, right? Ever since the AI, artificial intelligence craze kind of kicked in, right?
Yeah.
It started to move. If you look back farther, a year, 5 years, 3 years, 10 years, the U.S. market is just, it's probably a factor of 2 to 3, maybe even 4 times better return over that longer period of time. And so we've always kept a really heavy allocation towards U.S. at this point, just based on what the market is telling us. I'll go a heavier allocation towards international if it's doing really well, but if it's not, you're basically taking on more risk because for nothing. You're actually getting penalized for that risk because you do have an exchange between whatever currency that stock is in into the dollar, which creates another level of volatility. So if you look at the Vanguard Total World Index, it's not a bad measure to see, kind of what's going on. So Vanguard's thought process is that you should have your investments allocated in the way that the world is already allocated. And so if you look at the capitalization of every company in the world and you add it all up, let's say 9,000, whatever it is, stocks, and then you say, okay, how much of that capitalization is in the U.S. and how much is outside the U.S.? And that's the allocation you should have. That generally works out to about 60% U.S. and 40% international. Like right now, it's about 63% U.S. Because again, we've been doing a lot better during this 2020 move. So theoretically, if you follow that kind of model, you would have your 401k with almost 40% in international.
Mm-hmm.
You'd be pretty heavily underperforming altogether for
Yeah.
that broad-based international piece. So if I have a 401k where I'm adding money, that's different than just an investment, a lump sum, but I'm adding money every month or every paycheck or whatever it might be. I probably still have some exposure to international because I kind of want to accumulate that for the long term, but it's probably more in that 10% range at this point in time. And so, anyway, it's a great question. It's an area when international does go, like it did in the mid to late 80s. Yeah, you need to have it. I mean,
You have to have it in your
yeah,
portfolio.
it can really run hard, and everybody gets on that bandwagon. But for the last 5-10 years, I've been hearing different people on the radio and the CNBC and Bloomberg radio and the TV and all of it talking about international is the place to go because there's more value there. You can purchase things that are still not run up as much. Hasn't happened yet. It will probably happen, but man, you can wait a long time for that. So I'd keep the exposure a little bit light here, just until that story plays out. Again, if you want to play the individual countries and look at what happens, I mean, Turkey was running like wild, right? I mean, it was really hot segment, and then they had their earthquake and really knocked that down. So that's the problem with playing. I don't do those. I've actually never had that smaller country type of ETF in any of our models personally.
Yeah, because you could look at the Greek ETF. I think it's GREK, and it's up 30% for the year.
Wow, that's awesome. Yeah,
but that's a very volatile investment.
Yeah, exactly. Because you got currency exchange and a small country. I mean, these are smaller than a lot of the states in terms of their economic size. It's probably a lot smaller than some of these stocks that Apples and Microsofts of the world that are out there. I did see something interesting, just as a side note, when I was looking at getting ready for this question, looking at the Vanguard Total World Index. They have kind of like the top 10 stocks. So I think there's 7,800 stocks in that particular index. And Apple and Microsoft made up about 7% of that index. So if you think about that, they have 7% of the world's capitalization of the stocks that are in that particular index. That's pretty incredible. Both of those hit new highs within the last week or so. So that's incredible. The U.S. has been the place to be. It's where these things are happening, and I know when we live here, we all think this place gets a little crazy, but on a relative basis, it's still a great investment arena. It still does quite well. So it's a great place to live, and we live in Silicon Valley.
Yeah,
and it's even better, personally. It's expensive and all that, and traffic and whatever, but in terms of investing, in terms of knowledge, in terms of interacting with really bright people, this is a fantastic place. I really love it here for that purpose, and we get really plugged into what's happening in a lot of these different arenas, especially the technology arena. So I think it's it's a good spot.
So when does a single holding in my portfolio get just too big and too dangerous in a sense? I have a big concentration in a single tech company stock for who I work for.
Okay, so this actually comes up quite a bit here because a lot of these companies have done fantastic. So if you work at one of these big tech companies and you have, a lot of stock, you probably were given some stock, could buy some at a discount, basically. They got all kinds of purchase programs, and I always try to encourage people to get involved in those. And so here's the thing. I remember, client situation, worked at a company, and over the years, he'd run into a lot of different brokers and advisors that said, sell it, it's too much, and all this type of stuff. And he ignored that, and now he has it vacillates, but in that kind of $6 to $10 million range of that stock. And of course, this is a success story, and the other times where things didn't work out have to be considered. If you had $1 million, and then the stock and the company disappeared during the dot-com bubble. boy, that was crazy. There was a lot of really wild scenarios that happened. So you kind of have to take a look at the company. Are you talking about, one of these big companies that has very little chance of going out of business? That's one thing. If it's a small company that's just had a hot run, maybe you take some more money off the table. But what we advocate is what I call the fruit tree concept. And what you do is you identify a dollar amount that you feel is amount that you really want to keep in this stock. It could be a million, it could be 10 million. There's some dollar amount. So when it gets over that, you take it off the table.
Hmm.
And so let's say it's $1 million and it grows to 1.2 million. Well, you take the $200,000 out and you put it in a more diversified portfolio. You still have the million. It grows again to 1.2 million. You take the 200,000 out, right? And that way, if it drops down, to 500,000 or something, okay, good, you hold on to it and it gets back up. So again, you do that with 10 million, you do it with whatever it is. You pick, and that's your tree. And that tree is going to continue, if it works, to produce fruit. And so I think it's splitting the difference between holding on to it and not doing any diversification and then having something crazy happen. I mean, the thing that strikes me, like Silicon Valley Bank went out of business here. There's some founders and some company executives that probably had a tremendous amount of that stock,
Yep.
right? Could even be tens or hundreds of millions of dollars. And when that company, the run on the bank happened and it was seized by the FDIC, that stock went to zero.
Hmm.
So if you had $100 million in that, you now have zero. So now, that's not the best example because a bank is a weird institution, especially in today's world, because
Hmm.
you can, with a cell phone, move your money out of a bank now. And, there's services that move money for these big firms. And so, however, it does bring home the point that, almost any place can have problems. I mean, GE, right, dropped 90% from high to low at one point. It's now coming back. It's having a good year. But boy, that was a long ride down. We're seeing 3M, right? Fantastic company went from, really from a 300 and something dollars down to 90 something dollars, right? It's back up again to 103 or whatever. But, you know, anything can have problems. So that's where you want to kind of use this fruit-free concept. You just keep pulling pieces off, diversify out. And, I think that's the best way to split the difference. You're going to have to pay tax, on that. So ideally, you're doing it with pieces that have and in long-term capital gain arena, right?
Hmm.
So that you've had them for at least a year. You do those lots, pick those pieces out if you're going to sell. Long-term capital gains are maximum 20%, right? So that's not terrible, not great, but still, it's better because you can lose 20% in a single stock, a tech stock, in a week. So it's just a matter of trying to kind of pick off those pieces, diversify some a little bit at a time. And so I think that's the best strategy, personally. And we've had some success with that.
Yeah, and we can always test if you have a plan. You can always test. What happens if the stock goes to zero? What does
Yeah.
it affect my probability of success? And at a certain point, you can say, "Hey, I know if I don't believe in this company anymore, or something changes. If there's a structural change, then you have to augment your strategy. You can't just keep your strategy forever, too."
Yeah, we can actually test out like how big your fruit tree should be, right? I mean, we can stress test and say, okay, what happens if this big holding you have drops 50%? Nothing, good. That's, above what you need. But if it really makes a big change to your probability of success, then, we can find that level where you should be starting to diversify, um, and allowing for some drop of that stock. So, if you have $1 million and that works great, and we run it at 500,000 and it doesn't, then you might want to make your fruit tree $1 million.
Yeah.
Give yourself a 50% drop capability, and you take the money off the top of that $1 million. So that's how I would look at it. It's the best way to answer it is inside of a plan that does Monte Carlo simulation, to figure out what you can afford, and it depends on what other assets you have, what you're spending, and so it's a much more intelligent way to answer that question. But yeah, it's a good question. It comes up a lot for us here in Silicon Valley.
So, where should I keep cash? I know I have this big expense coming up in 1 to 2 years, and I need to, save up cash for it. But how do I not just keep it in the bank, gain nearly nothing?
Yeah. So yeah, it's interesting actually because still some of these large institutions, the big banks, although they did a lot better, than the regional banks in this, kind of crisis, they're still not paying much on like savings and checking.
They haven't really moved up at all.
Really, they're making some money there, but they're not paying it out. And so, um, what you want to look at, because timeline is a really important component of investing. So if you have a 1 to 2 year outlook, you know, let's say you put it in the S&P 500. Hey, I'm going to roll the dice and put it out there and try to make more money than the bank account. Well, if you look historically at 1 and 2 year rates of return, there's an awful lot of negative ones in that
Yeah.
shorter time frame. You look at the 10 years. I have 10 years before I have that expense. There's only a few 10 years that had negative return. So that's where the stock market really works, that long-term aspect. So for me, a 1 to 2 year is not long enough to be in the stock market. Now, people do it all the time, lots of times. I wouldn't do it, and I wouldn't recommend it. And so, what you really want to look for is things that have the capability of being essentially guaranteed. You have an expense. So to me, that's a guaranteed outflow,
Yep.
right? I'd like to match that with a guaranteed inflow, right? So a CD in today's environment, getting over 5% on CDs now, maybe get a CD that's going to come due, just before your expense or outflow
Yeah.
is going to happen. You have a guaranteed inflow, especially if it's less than 250,000 per institution. So if you have a bigger expense than that, you might want to divide it up into different institutions. But it's FDIC insured, all those type of things. And so you can get, that expense, money in hand to pay it on a guaranteed basis. You can do that with different treasury bonds and whatnot too. All those CDs are paying pretty decently compared to treasuries right now, and they're quite easy.
Yeah, and if you don't want to lock yourself in to a CD per se, let's say you think it's between 1 and 2 years, but you don't know what time frame, you could do a money market.
Yeah.
Money markets also pay slightly less than a CD, but they're still pay more than your usual savings account, and you can still have that flexibility.
Yeah, exactly. And they have complete liquidity, so you can get out of that without any problems. They sell at $1 a share. Only a few money markets have ever had trouble with that. Some of the really high yielding ones that were kind of taking bigger risks had some trouble with that over the 37 years that I've been doing this. And so when you go to sell them, you're still selling at $1 a share. And so, that liquidity is very nice inside of a money market also. So those are some ideas for short-term investment needs. And honestly, they weren't really available before they started raising rates because money markets were paying like zero, essentially, or 0.1%, and CDs were paying 0.15 or something. So this is a new invention, so to speak, with this higher interest rate environment. That there are some vehicles that can be used here, especially for those types of events. So yeah, it's good stuff. All right. Well, that's the end of our show today. I want to thank everybody so much for coming. Again, we will not be here next week. I'm going to be out of town actually, so we'll see you in 2 weeks. And please send in your questions. We'll be here in 2 weeks, and we can answer those questions. If you want to send them in the interim, it gives us some time. Like some of these questions, we were able to look up some information also, so we can answer them more completely. And of course, you can go to our channel if you want to continue your education along these lines. That's what this channel is about. And you can subscribe to the channel, hit the subscribe button. You can hit the little bell if you want to get notified when we put new content out. And of course, we will have, our appointments are available. If you'd like to meet with Ethan and I, it is a little bit tight right now, but you might find somebody that cancels or what have you. But again, set up a 30-minute, in-person, phone, video appointment, whatever works for you, and we will, sit down with you and answer your specific questions. So I want to thank everybody so much for coming today, and really appreciate it. Thanks for all the great questions, and looking forward to seeing you in a couple weeks.